Welcome, everyone. I'm Alex Smith, Head of Marketing at Mortgage Automator, and I'll be your host today. Thank you for joining us for Before You Fund, the Due Diligence Blueprint for Private Lenders. Before we get into it, just a few quick housekeeping notes. This session is being recorded, and we'll send a link to the recording after the event, so don't worry if you need to step away. We're doing this one without slides, so the whole idea is to have a real conversation with some of the best people in the business on the topic, so we're just going to talk. We'd love to hear from you throughout the session. So if you have a question for the panel, drop it in the Q&A box in Zoom at any time. We'll be collecting those and fielding them mostly at the end, but if something urgent comes up, I may work it in earlier. The chat is also open if you want to say hello or share a reaction. Now, let me quickly introduce Mortgage Automator for anyone who's new here. We provide loan origination and servicing software for private lenders across the US and Canada. Our platform is purpose-built for the workflows private lenders actually use. And part of that is our integration ecosystem, which includes partnerships with the companies our panelists represent today. While we're going to focus on challenges and trends, our guests today can also offer practical guidance for adding due diligence best practices into your everyday workflows. So let's meet everyone now. I'll ask each of you to introduce yourself briefly. Denise, let's start with you.
Absolutely. Thank you, Alex. Good afternoon, everyone. My name is Denise James. My role at Zactus is Senior Vice President of our Origination and Servicing Quality Control, Fraud, and Tenant Screening divisions. Zactus integrates with Mortgage Automator for credit reporting, fraud prevention, and identity verification solutions. It's a pleasure to be here and be a part of the panel. Thank you for having me.
Thanks,
Hi, everyone.
Victor.
Hi, everyone. My name is Victor Tay. I'm the CEO and co-founder at Minerva. We're an anti-money laundering financial crimes platform, and we integrate with Mortgage Automator to do anti-money laundering screening. I think important to this conversation, my life before being a founder, I was the Chief Anti-Money Laundering Officer over at Wells Fargo Canada, and I also ran the Head of Data Analytics and AML Strategy over at CIBC. All this really to say I've been in the industry for 20 plus years, and it's a real pleasure to be here today with you guys.
Hi, everybody. My name is Megan Askin. I'm SVP of Sales at AFX Research. AFX is a nationwide property research firm that specializes in public record verified title reports. Since 1995, we've researched more than $2.5 trillion and assessed property value across multiple industries, including the private lending space. Through our integration with Mortgage Automator, lenders can access fast, flat rate title updates, otherwise known as current owner searches, directly within the platform. These reports give lenders a verified snapshot of title at moments that matter most, like early collateral screening, construction and renovation draws, and any point where capital is on the line. Thank you for having me, Mortgage Automator. I'm happy to be here.
Chris?
Hi, everybody. I'm Chris Anderson with Trinity River Financial Insurance. We're an insurance agency that's based out of Dallas, Texas, and works specifically in the private lending and real estate investment space. We provide lender-placed insurance and REO coverage to lenders in all 50 states, and also borrower coverage for anything fix and flip, rental, single family 1 to 4, multifamily, commercial, and we even do flood insurance as well.
Awesome. Thank you all for introducing yourselves. Appreciate you being here. Before we jump into our first question, we did want to make sure we're focusing on the biggest concerns you all have. So we're going to run a quick poll. If you could just tell us, when you look across the private lending landscape right now, which of these loan products do you think are carrying the most hidden risk? The options are fix and flip, bridge, construction, DSCR. If you could just choose one, we're interested in the most risk. So we'll just give it a few seconds for you guys to answer, and we'll take a look and see if our speakers agree. We'll just give it another couple seconds, get some more answers in. Looks like it's a pretty close tie between fix and flip and construction at the moment. I think we'll give it just another second if anyone else wants to jump in, but it's looking pretty consistent. Let's go ahead and end that poll and show the results. So we've got construction and fix and flip tied with 40% of the responses. So What do you guys think about that? Let's start there. Are these loan types really exposed to different kinds of fraud, or is it more or less the same problems wearing different clothes? Denise, what do you think?
It's pretty much wearing different clothes. It's definitely a different landscape out there today. Each construction project or project that's being looked at, the underwriting around that is around the ability to repay and the income actually mitigating any kind of potential obligations against the property.
I would add to that from the title's perspective, construction loans and any renovation project involve multiple funding events, creating more opportunities for liens or judgments or any kind of other types of title issues to emerge after origination. So ongoing title visibility is important because lenders continue deploying capital throughout the project. And that's why, yes, I would say they carry the most hidden risk as well.
Chris, any thoughts from you on the insurance exposure angle on this one?
Yeah, I agree. I think it's construction and the fix and flip. We're seeing that the fix and flip is because of the amount of time it's taken to get those houses either sold or get a renter in there. There's more exposure there because the property's going to sit vacant, and the longer it sits vacant, the more trouble can occur. So and then on the construction side too, I think there's some hidden risk there with the draws and the draw requests, and there's some fraud potentially hidden behind that occasionally.
Makes sense.
Mhm.
All right, let's zoom into entities because I think this comes up a lot in private lending. A lot of these borrowers come in as LLCs or corporate entities. How does that change your due diligence approach? And have you seen fraudsters use that corporate structure to their advantage?
Well,
Mhm.
what I would say is an emerging risk landscape and what we see, irrespective of the type of loan, is that digital synthetic identity fraud is still huge. And so that doesn't exclude business entities. Just a couple of stats very quickly. I mean, that particular type of fraud where we're looking at anonymity around creating entities, there was a 311% jump just between 2024 and today. So AI has built borrower pass verifications and then they bust out. When you start to look at other loan types like DSCR loans, debt service coverage ratios, 1 out of every 27 multifamily applications are flagged. Why? Because you probably have some type of business entity takeover. So really doing a deep dive into the business entity, who owns it, the beneficial owner, as well as who has the ability to sign for that for that particular loan. Who are all of the connected entities? Are you going to see funds transfer between entities that may not necessarily have been introduced to you in the past? These are things that we can certainly see as it relates to business entity attacks and issues.
Yeah, I
Yeah,
totally.
that's.
Oh,
Go ahead, Victor.
I was going to say, I totally agree with Denise here. LLCs and corporate entities are very, very common, and they're typically not the problem. It's always the people behind the companies that are posing the risk. A company can look super clean while the real risk sits behind it. From an AML perspective, the key questions, and I think Denise already nailed this, is like who owns it, who controls it, and who's benefiting from the loans. A new LLC being created has very little history, no bad media, no sanction exposure, but it's the people that behind it that are going to carry the fraud issues, the lawsuits, the sanctions, and other red flags. So just screening based off of a company name is typically not enough. You need to understand who's behind it and why they're here. Fraudsters are typically using companies to create distance and create a sense of legitimacy, and good due diligence is going to close that gap.
Chris, did you have something you wanted to add there?
Yeah, I was just going to agree with Denise that we see people continually creating and recreating different LLCs to try and cover up their claims history. So it becomes an issue on the insurance side too, as they're running away from a loss ratio.
Yeah, interesting. Let's talk a little bit about some growth. So we've seen private credit grow dramatically over the past few years. And now we're seeing institutional capital enter the space as well with its own compliance expectations. Has that changed what private lenders are expected to do in terms of due diligence? And do you guys think the industry's keeping up?
I can start off here. Yes, the expectations definitely have changed. Private credit has grown very quickly. There's more capital, more brokers, more partners, and more pressure to move fast in the entire ecosystem. But more volume doesn't always mean better controls. Bad actors are always constantly looking for weak links in the chain. So if one lender has a strong AML or fraud program and another doesn't, well, guess where the bad actor is going to go? To answer your question around, is the industry keeping up? I think it's definitely improving, but it's not uniform or evenly. And the good thing is the bar is raising overall, and everyone now needs to show what controls they have in place, who's behind the deal, and what risk they found, and more importantly, why they're accepting this risk if they find any. Firms that are keeping up are treating due diligence more like a real risk management activity and treating it as a competitive advantage rather than just a checkbox activity.
And Victor, I would 100% agree with you. And the only comment that I would make to that probably tags on to what you've said is that while there are lenders that practice comprehensive due diligence, I believe that some may still believe that the collateral will mitigate the losses. So there may be some gaps there in terms of the belief of being able to mitigate your losses. There's a false sense of security risk. By the time the first incident is uncovered, you may have opened the door to attacks on the organization. And before you know it, you have a ring, and then you have millions of dollars in losses. So due diligence is multi-layered with different approaches to each program that you're funding. Fraud is profitable to the threat actor, but devastating to the victim, and that's your organization.
Right. I would agree with all of that. Go ahead.
Oh, no, go ahead. Go ahead, Chris.
Uh, I was going to agree with all of that. And, this private capital space too, it's all about speed to close. And there are so many different tech companies and AI companies coming in to help support all of that as it continues to require more due diligence. So I think it's trying to keep up and getting there pretty quickly as everything's evolving.
Yeah, you mentioned that pressure to close fast. So where does that pressure create gaps, and how are bad actors taking advantage of that?
I can speak to that. The greatest pressure that I see affecting lenders is the pressure to be fast, because with speed, lenders win deals, they close faster, and they execute more loans. But speed without due diligence is just faster risk, and it often creates big delays and expensive problems. When private lenders feel pressure to move quickly, one gap that emerges is the tendency to bypass an early collateral screening. When lenders skip this step, bad actors can exploit it. For example, a borrower could present themselves as the owner of a property when the public record tells a different story. Things like undisclosed liens or debt or recent ownership transfers that don't match the public record are exactly the kinds of discrepancies that can go undetected when the process moves too fast. And the faster the process moves without verification, the less likely it is that anyone catches it before resources are committed or even funds are deployed. And then similar gaps emerge, like we talked about earlier, during construction loans. Lenders continue deploying capital at each draw, but the title doesn't stay static. Mechanics liens from unpaid contractors or subs are often filed between draws, and this jeopardizes the lender's lien priority. Any number of things really can happen between funding events that a lender will not see unless they're checking. And, the gap is not always a bad actor. Sometimes it's just a borrower who hasn't paid their subs and doesn't mention it. But either way, the title should be checked. And going back to the pressure of speed, maintaining speed is a primary concern for lenders. but with an average turnaround time of 0.43 business days on our title update reports, lenders don't have to sacrifice speed for title visibility.
Yeah, Megan's totally on point here. Speed itself isn't the problem. It's when speed is used as an excuse to cut corners. Yeah, the way that I see it, there's always going to be a healthy tension between the business side and the compliance side. On the one hand, your business wants to close fast. On the other side, your compliance needs to make sure they know who they're dealing with and the risks involved. And the friction that I've seen throughout my career is that friction happens when compliance is looped in way too late or the process is way too manual. At that point, people are super invested in the deal and they want it to close, and compliance will always feel like a blocker in this scenario. And these bad actors, they're smart. They know how to use this pressure, this tension, as an advantage for them. They count on lenders accepting documents too quickly, missing ownership issues, or not scrutinizing certain questions. So the question or the solution isn't to slow everything down here, but instead it's to get compliance involved earlier and to automate the repeatable work and use technology as an aid here, right? This is going to enable both the business to move fast and compliance to move in lockstep with them.
Yeah, I would
Yeah.
100% agree. I mean, technology is also part of helping you to move smartly, to maintain your speed to closing, because we know that that's also a competitive advantage. As Victor stated, partnering with the right companies like Mortgage Automator and all of the companies that you see up here, we're providing platforms and solutions to help you maintain that speed without necessarily including or excluding those critical checks that are required in order for you to minimize your risk.
Yeah, and I think the key tech that everyone's always talking about, and another thing that Chris already alluded to, but things that can speed it up is AI. So let's talk about that. On the fraud side, how is it being used to fabricate borrower profiles, manufacture documents, pass surface level screenings? Somebody actually asked here already, how can you ensure an LLC is verified? Is it easy to falsify corporate docs and operating agreements? I think you can probably touch on that here too. What does a convincing AI generated package actually look like?
Yeah, it's super easy now to make convincing packages. AI is changing the unit economics of fraud. In the past, when you're building a fake package, it took a lot of time, right? Like you had to create fake bank accounts, invoices, company documents. You might have to do websites, emails, but now you've got like an entire borrower story in seconds. And that's what makes it so dangerous. Just the abundance of information that can get created. The package looks relatively clean. The documentations are abundant. Story sounds super believable, but all of it can be fake. The hard part here is the mismatch. When fraudsters can create all this information so quickly, but it still takes compliance teams, lenders, organizations hours or days to verify it. That's when you get, the gap. Lenders now not only need to take a look at the information and process, does this look real, but they also have to answer the questions, can we prove that this is real? Are the parties legitimate? Do the addresses match? Do the bank records make sense? Are there lawsuits, bad media, or hidden relationships? With AI, fraud is getting, easier to look legitimate, and due diligence is taking that extra step to look past that surface. AI can also be used just as equally to vet and validate all the documents, synthetic IDs, if bank statements have been altered. So leverage it. Use technology to your advantage.
I would just add to that to just say, I mean, Victor's hit the nail on the head very nicely. There's just a fraud shift. It's no longer document alteration, as Victor has mentioned. It's actually end-to-end identity simulation. So with internally consistent borrower ecosystems built in minutes. So it's no longer, look for the errors. Now it's, if it looks too good, there's probably something there that you need to look at. So the signals are, does it look too good to be true? But just to give you some stats on AI-enabled fraud losses, they're projected to grow from $12.3 billion in 2023 to over $40 billion in 2027. That's a 3 times increase in 4 years. So how is your company going to be affected by that? AI-generated document forgeries climbed from 0% in 2021 to over 57% in 2024 of all detected fakes. So AI is pervasive. It is definitely coming in to areas where you're not thinking about. So there are three converging tactics to consider. As Victor mentioned, fabricated synthetic identities, digital synthetic identities, not just on the borrower, but your entity, the business. Manufactured document stacks. Are your tax returns legit? Have they been amended? Are you able to order those tax returns through a third party to verify that the information being provided to you is correct and authentic? Articles of incorporation, business license takeover. We talked about that earlier. Dormant businesses already registered and have been taken over. And the third and last would be deepfake enabled verifications. So now you can use your phone, you can take a picture, you can verify yourself, but is that a live person? So are you checking for liveliness? Is your technology elevated enough to mitigate anonymity to a point where an entity can apply for a mortgage and close that mortgage without ever being met, and then using that unlive individual? So consider the multi-layered effect that AI can, be I want to say, generate against your business.
Yeah, but as Victor said, it can also be helped with detection, like you said,
Absolutely.
liveliness. So where is it genuinely useful in your due diligence workflow to leverage AI? Where does it still fall short? Are there tasks where you would trust it and others where you really want a human still involved?
AI is genuinely useful in due diligence workflows, but it's most effective as a powerful assistant rather than a replacement for human expertise. AI excels at processing very large volumes of documents very quickly. Documents that may be hundreds of pages and have in the past required hours of human review can now be read and extracted in seconds, and this not only saves time, it reduces human error. Where AI falls short, and this is particularly important in title, is public record retrieval. Many counties actively resist automated AI access because of privacy, security, and fraud concerns. As a result, counties often employ anti-scraping protections, CAPTCHAs, login requirements, fees, and other controls designed to limit automated access. If counties if they permitted bulk scraping of public records, AI systems could potentially harvest ownership records, they could harvest deed histories and lien data to identify unencumbered properties, distressed homeowners, or they could even re-expose domestic violence survivors who have spent years trying to conceal their addresses. The Supreme Court actually has recognized that compiling thousands of individual public records into a database creates a privacy harm that looking at any one record alone does not, and that counties have the legal backing to restrict bulk automated access. At AFX, we have built our research process around this exact reality. So our nationwide network of certified abstractors actually obtains county level documents directly. Then we use AI to read the documents and extract the relevant information. Our proprietary algorithms run 2,000 logic checks on every report, flagging for any kind of inconsistencies or anomalies. And then those flags are reviewed, interpreted, and resolved by our human QC team prior to delivery. So again, obtaining, validating, and interpreting public record information still requires significant human involvement. AI can enhance it, and this human plus AI research process is really the right model for title work, because combining that certified abstractor research with the AI reading and extraction, and then the human QC, it really ensures the title accuracy and the speed that lenders require.
Alex, can I just comment on that really quickly?
Yeah.
So, your question was, where is it lacking? I think also we need to look at the flip side of that. How do we intelligently incorporate AI based on what we have available today? Because AI is truly a tool that can be used for efficiency lift. So if you already have processes in place, and we know that we're unable to necessarily scrape, public record data with AI, then how can you build AI in your workflow to spend less money? At Zactus, we're always talking about how can we prevent waste? How can you utilize our tools to ensure that you're getting the information that you need, it's consistent, you have access to third parties, and then partnering with Mortgage Automator, you're able to also be able to leverage that in those workflow and work streams so that AI can provide some level of lift in the process itself. Look for the flags, look for the signals that tell you that something just doesn't look right. So AI doesn't have to be the end all be all. We're always going to have that human in the loop that can make that final adjudication on whether you should move forward or you should escalate.
Fabulous.
Great.
But I think a lot of private lenders do that domestic background check and maybe consider their due diligence done. Victor, can you take us through a scenario where maybe a global screening would have caught something that a standard US check would have completely missed?
Yeah, domestic checks are great. They're very useful, but they're not the end all be all from a due diligence aspect. Looking at one country and a narrow set of records may catch local criminals or issues, but it can miss global sanctions, foreign enforcements, political exposure, adverse media, or fraud outside of the US, or in my case, Canada. So I've got an example. Former bank that I used to work at, we had a client in question, passed all of the initial light screening domestic checks, and they looked super clean. We onboarded them. 6 months later, there was a trigger-based event from a transaction monitoring event. We did a broader search only to realize that they had massive media exposure and fraud across Europe and in Asia. Now, had we done this check earlier, we would not have onboarded this person. Now we needed to take the time, the money, the energy to unwind this relationship. And that was the gap. Someone can have no domestic risk, but carry real financial crimes or reputational risks. So private lenders should not treat domestic background checks as, the end all be all or enough. The right approach is taking a risk-based one. If a borrower or owner or source of funds or related company has any signals that point outside your domestic jurisdiction, you might need to take a look beyond a local check.
And from a pure AML standpoint, what are the red flags that private lenders should be most likely to overlook, or I'm sorry, would be most likely to overlook?
Yeah, I mean, there's a few different red flags that I would say are outside a normal credit file. The first one is ownership. Who really owns and controls the company? Second, hidden relationships. I think it was mentioned a couple times. Like there might be multiple layers of LLCs, different setups made. Are the borrowers, brokers, guarantors, vendors, or related companies somehow connected to this? Is there political exposure that we haven't explored? Or is there adverse media that goes beyond a domestic search? I'm always a little bit surprised when an organization tells me that they've skipped things like adverse media. I mean, for me, when I go out to a restaurant, I'm always going to do a Google review check to see, just to get a better sense. But somehow we skip that step when looking when we're trying to onboard somebody. So to me, it doesn't really make sense.
Now, what about title searches? Megan, they often get treated as a closing formality, but can you make the case for us that they're actually a frontline fraud prevention tool? What do you find in title research that should be stopping loans before they fund?
Yes, absolutely. So title is the story of a property, and a current owner search will provide a public record verified snapshot of that story. In asset-based lending, collateral is the property itself. So ownership and encumbrance details have to be verified prior to committing capital. So a title update obtained as an early collateral screening is a strategic risk prevention tool. The goal being of early collateral screening is to identify non-viable opportunities as early as possible so that resources can be focused on loans with a realistic path to funding. For lenders that are evaluating a high volume of opportunities, the impact of automatic early collateral screening is significant. Title updates also serve as fraud prevention tools because verifying the public record uncovers discrepancies between what's being presented to the lender and what's actually on the title. Some of the common discrepancies that surface in a title review are, number one, the person applying for the loan isn't the person who owns the property, is one. There could be undisclosed trust or LLC structures, recent ownership transfer activity, or you could discover some unexpected liens, judgments, or second liens. And what we're finding in title research that should stop loans before they fund goes beyond title discrepancies. The FBI has identified deed fraud as one of the fastest growing financial crime categories in the United States, and it shows up in the title research. A reverse mortgage signals an owner over 62 with significant equity. An estate deed signals bereavement and a potential family complexity. So these are exactly the types of profiles bad actors will target, and they're visible in the public record long before a loan application arrives. Also, construction lending is another area where title visibility pays off, because again, between origination and a final draw, any number of things can change. Again, mechanics liens or judgments or tax liens can show up in addition to other things. So obtaining a title update before each draw is really the only way to confirm that the title's clean before capital is dispersed. Without that, a lender risks funding into an undisclosed encumbrance, and in a default scenario, that could mean not getting paid back at all.
Those are super helpful examples. I think the examples really make it concrete. What are some other fraud patterns you're seeing in private lending right now? Any other examples?
Well, I've got, Alex, two loans. Both are fraud, and they tie into what could happen in private lending because these were non-QM loans. So the first one I have is a PPP fraud example where we had a loan come across our group. It was about $5 million in value and total number of properties, probably about 4. Every single one of those used shell companies. And we were able to find those shell companies because we did the research using our tools in order to locate and find that this person was using shell companies with no employees, with a lot of revenue, and that revenue was being used in order to approve that loan. So all of these shell companies were used in the transactions for the refinance, even though this particular borrower and his partner were convicted of PPP fraud. And they used the exact same shell companies in order to secure $1.5 million worth of cash out on all of their properties. So that was one example where we were able to stop that transaction. We notified the lender. We did an adverse media search, and that's exactly what uncovered everything. So we were able to see that this person was absolutely convicted. They were kind of the poster child for the first case in one of the states for PPP fraud, and we were able to provide that to the client, and they were very happy about that. So it does tie in. The second one was a cartel associated fraud where we had a loan come in, and this borrower claimed to sell about 50 tractors a month. So, I wanted to call John Deere and ask for a job there because that's a lot of tractors. A closer look at the property revealed that the business was a residence with several cars on the property. When we looked at the bank statements, there was evidence of manipulation, and we submitted those bank statements to our third-party providers through Zactus, and we were able to get that verification that came back that said, nope, these don't match, this is manipulated. And then there was evidence of manipulation in regular deposits from Mexico, about 50,000 per. So we started to look more into it and the business license, found that the borrower had no business license, no documentation to prove that he owned the reported business, and the loan was also stopped, and the lender reported the incident as fraud. So again, just, AI had nothing to do with this. This was stop, look at the signals, make sure that you're checking everything. If the hairs on the back of your neck stand up, that means there's probably something there, and you should just take a minute to stop and take a look.
Denise, those are incredible examples you just gave. I do have a story to add, but those were really great. One pattern that we see, and I mentioned earlier, is undisclosed debt that doesn't align with what's being presented to the lender. And one of our senior researcher at AFX, Nancy, actually told me this story. So it involved a property owner who was applying for a new loan. And during the title review, a recorded deed of trust appeared on the property, but the owner questioned it because they believed there was no loan on the property. So that prompted some investigation, and it was discovered that the property owner's accountant previously had arranged a loan with a different lender. The owners at that time had signed the deed of trust, but decided not to move forward with that transaction. So they just assumed the accountant would just tear it up. Well, the accountant recorded the deed of trust anyway, received the loan proceeds, and then made payments on this loan for years. So it wasn't until this new loan process was started and our researcher found this deed of trust that they realized what had happened and that their trust with this accountant had been betrayed. And also that title review alerted the new lender, the prospective lender, to the issue that warranted an investigation before moving forward with that transaction. So in private lending, where borrowers are often using property as collateral for a bridge or a fix and flip loan, an undisclosed recorded encumbrance means the new lender's lien position is compromised at day one. So this example is case in point for early collateral screening.
What about specific geographic markets or property types? Any areas where fraud is clustering, maybe help some of the lenders on the line avoid those markets? Anything that lenders should factor into their underwriting for specific areas?
Yeah, I'll take this, Alex. So there's a really good report out there. Cotality tracks mortgage application fraud, and they put out a report that's quarterly. And the most up to date that I have is Q2 from last year, from 2025. But there was a 6.1% increase last year in application fraud. So, and the bad actors, so to speak, in those cases were New York, Rhode Island, Connecticut, California, and Florida. So some of those you could probably guess, but Connecticut and Rhode Island is a little bit unique. But there's 6 types of fraud that they are tracking, and it's identity fraud, transaction fraud, property, income, occupancy, and then undisclosed real estate debt. And the undisclosed real estate debt is one that has skyrocketed in the last 12 months for some reason. So, and it's really bad in those 2 states, Connecticut and Rhode Island. So those are something that maybe you want to take a deeper dive into and check on and see what's out there and what's going on. But from a lending standpoint of what type, multifamilies are always the worst for whatever reason. And then refinances and investment properties are after that. So And in the traditional QM space, whatever you want to call it, there is a repurchase liability insurance policy out there or a buyback policy that you can get, but it has not made its way down to the private lending space yet, just because the amount of risk that there is in this space versus that space.
Absolutely. I wish I could add more to that, Alex, to what Chris said, but I think he zipped it all up. And I mean, ultimately, the common thread is that undisclosed real estate debt dominates on every top state. Non-owner occupied properties are triggering alerts at 2.5 times the rate of owner occupied residences. So, we all want to be Airbnb kings and queens, but at the same time, and we want to be investors. But look at the shift from QM loans to now investment properties, 1 in every 44, 3 times the industry average. And then we assess multifamily transactions, as Chris mentioned, 1 in every 29 applications are remaining hotspots for fraud. So this is your space. And so looking at that, making sure that you have everything tied together will help to prevent you from being one of these statistics.
Awesome. Let's think about a bit more about that worst case scenario. So a borrower disappears mid-project. Walk us through what a lender's realistic options are and how much does documentation quality and insurance coverage even actually change the outcome?
Oh, yeah, that's a great question. So, and a lot of lenders are hung out to dry when it comes to insurance coverage when a borrower is walking out on them too. So, typically borrowers are going to stop paying their taxes and their insurance, 1 or 2 and 1, depending on the direction they're going. But that's what we see first. So the property is there without coverage. So most lenders are trying to either dump that property ASAP, or they're going to take that property and continue the rehab. Or if it's a profitable rental, then they'll continue on there as well. So they need to make sure that if they do have a lender placed policy in place, that it does have builder's risk coverage with it. And then if they do have to go into foreclosure, then it's going to become an REO at that point, and it needs to have liability coverage there as well.
Looking at it, I can jump in here. Looking at it from a pure AML standpoint, once a borrower disappears, you're really in more of a lessons learned mode. And here's 3 things that you can essentially do. Number 1, identify if there was real suspicious activity or something really egregious that might need to be potentially reported up to based off of your regulations. If there was, it might mean that you need to file a SAR or a voluntary SAR. Second, internal protection. The borrower, the beneficial owner, related entities, addresses, phone numbers, email addresses, or any connected parties to this deal, you may want to add them into a internal do not do business list or some sort of internal watch list for go forward screening. And the third, do some self-reflection. Like, what did we miss? Was the ownership unclear? Was there any documents that we accepted at face value? Was there adverse media that was skipped? Did we rely too heavily on a particular control? These are all potential opportunities to beef up your program to help mitigate for future events. That's where the real value is from an AML aspect.
Yeah, makes sense. Chris, what coverage gaps do you see most often? So when a lender comes to you after something's already gone wrong, what should they have had in place before the loan even funded?
Most lenders will come to us and they need to force place. And typically they find that out after the fact. So they've already gone 2 or 3 days or weeks without coverage. And now they're looking for coverage on that property and they're needing a policy put in place. But you're going to have to get a policy underwritten. It's typically, 2 to 3 days to get that. Some are quicker, but overall, you're going to have to jump through the hoops of an application. So what we advise lenders to do is to get a master policy put in place. So you can get that done very easily. All it takes is some information on the types of loans that you're doing, the typical amount. The underwriting is very simple. And then you have a master policy for force placing and REO sitting on the shelf, and they're ready when you need it, as opposed to trying to scramble and figure it out when you do need it. So to add on to that too is, wind coverage has been hard to get in Florida the past 5 to 6 years, and it's lightening up some. But with a force-placed master policy, you can get wind-only coverage too. So sometimes that renewals carriers are not offering wind coverage, so it can be force-placed there then when the loan does renew. And same thing with flood. So you can get a master policy for flood insurance as well.
Great tips. I'm going to ask one last one, and I'm going to ask each of you to answer. If you do have any questions, everyone who's watching, feel free to drop those in the Q&A, and we'll get to them in just a moment. But first, just want to ask all of our panelists, if you could change one thing about how private lenders approach due diligence today, what would it be? What's the habit or the shortcut that creates the most unnecessary exposure?
Well, Alex, I would say that product-specific due diligence is non-negotiable. Every program that a private lender engages in or transacts fails differently. So the controls must be tailored to plan credibility versus income credibility. AI has collapsed the cost and skill barrier for fraud. Digital synthetic borrowers and businesses are coming live. Clean document kits, deep fakes now defeat manual reviews. So employ services or a multi-layered program that helps you to detect at each stage. Although we're talking about AI, intelligent solutions that are streamlined and consistent can assist with plugging holes in the risk due diligence floor. That's what I would have to say at this point.
The one thing I would change from a habit perspective is treating due diligence like a checklist. Rather, turn it into a goal for your organization. And that goal being, do we actually understand who we're doing business with? The biggest shortcut is over-reliance on what the borrower gives you. Fraud works best when bad actors can exploit trust. So trust but verify.
If I could change one thing about how private lenders approach due diligence today, it would be to make public record verified title updates a standard part of both early collateral screening and ongoing due diligence. With so much capital chasing deals and so much pressure to close fast, many private lenders incorporate aggregated property data into their workflows. And while aggregated data is very useful, it is inherently downstream of the public record. So before information reaches an aggregated database, it has to be first recorded by the county, then acquired, then processed and normalized. Also, counties differ greatly in how quickly they record and digitize documents, which means that aggregated information might not always reflect the current public record. So I'm just saying that when lenders are making decisions involving collateral, capital deployment, or lien position, obtaining the most current and accurate title information available is critical. And through Mortgage Automator's fraud prevention toolkit, lenders can obtain county verified nationwide title updates, typically delivered in less than a day, because the most accurate picture of collateral comes from the source records themselves.
Yeah, I would add to that too. So if you're familiar with the National Private Lending Association, the NPLA, they have stepped in and helped to prevent the fraud in the private lending space. They have created what they call a fraud watch list that you can, if you're members of the NPLA, you can log into that fraud watch list and review. And it's just some extra due diligence there as you're originating loans.
A couple questions that have come in from our audience today. If you could explain why a bad actor can impact your collateral in a loan. If the protection on the property is perfected, so title is clear and secured, how will that cause an issue to the lender if the borrower is fraudulent?
So the title's clear, they're saying.
Yeah.
Well, I think it could cause a buyback, right? If there's fraud on the application, even though the title is still clear, the secondary market could mandate a buyback on that. Um, could still be a performing loan at that point. You never know, but um,
Yeah. There's another question. I'm actually sorry, not sure where this one was related to. Jeff, if you want to just clarify the further discussion you want. You mentioned you're an asset-based lender and you rely on property characteristics and not so much the borrower's profile. Maybe that's a follow-up to the above, I guess. Do you guys have thoughts on that, the property characteristics versus the borrower's profile itself?
I mean, I would imagine I can take a stab at this one. So obtaining a third party property report so that you understand not just the collateral that you're transacting on, but what else exists in that area. So not relying on a simple AVM, but a full characteristic report on who owned that property. So property ownership history, what the foreclosure REO short sale activity looks like in the neighborhood. Does that borrower own multiple properties in that area? Are you seeing an uptick in foreclosures, rental properties? So there are reports that are available out there that can help you to really understand the type of collateral that you're looking at and the risk around it. And then does the story make sense? So does your borrower, your entity coming in, telling you that I can get $5,000 a month on this property when the average rents are $3,500? So those are questions that you can actually ask as you're looking at these types of documents.
Perfect. What about if a lender tells you guys they don't have the budget or bandwidth to add another vendor into this process? How would you respond to that? What's the real cost of not doing this?
What's the cost of not doing it, right? If you don't do it and you get, as Chris mentioned, a buyback, or maybe you're doing QM loans and it's a mix of QM and private lending. Can you afford, how many properties can you afford to try to mitigate in the losses when your borrower doesn't repay their obligation? So if you've got a $2 million construction project, or you've got 3 properties that are fix and flips, and you're relying on the income to actually on the collateral, and that person walks away with funds, or they walk away from the project, can you afford 3 of those properties? Do you afford those in your portfolio? So the risk is really about this is like insurance. And I know Chris is probably going to jump in a second here, but insurance, we pay a lot of money for insurance, but when you have it, you can rely on it. And that's kind of how I liken due diligence and risk mitigation to this specific industry.
Agreed. Yeah, you're transferring risk of that loan, right? So, how much more do you want to do to prevent a potential buyback or a major loss? It's hundreds of thousands of dollars that these lenders are handing over to a borrower. So, um, it's a great question, but I mean, how much can you afford? How much risk can you assume on your own? So,
And I think developing a relationship with your vendors to help them understand where your budget is, and being very honest and real about what you feel the most risk concerning component of your process is. Your vendors will sit, they will listen. If they're really good partners with you, they're going to help you move through this, and they're going to make this a palatable solution for you.
I think we have time for just one last one. Victor, earlier you mentioned the tension between speed and compliance. Is there a version of this whole process that is genuinely fast and genuinely thorough, or is there always going to be a trade-off?
I think that there will always be a trade-off, but you can definitely narrow the gap. As mentioned earlier, with adoption of technology, both sides can get faster. Compliance doesn't need to be a bottleneck in the overall situation. Compliance can be a value add partner at the start of the process rather than a afterthought when you're trying to close the deal in the 11th hour. So I think there's always going to be tension, and I think it's actually healthy tension between the two sides. But with adoption of technology, with closer collaboration between the two sides, it doesn't have to be a bad thing.
Yeah, I would add to that as well that with being integrated in platforms like Mortgage Automator, lenders can access this due diligence in one place where we're already within their workflow. For example, like many lenders are already juggling multiple title companies, but to be able to just order a current owner search within your workflow, and it's one vendor nationwide, it makes that due diligence so accessible, and it can be an automated part of whatever loan processes you're engaging.
Yeah, absolutely. I did want to mention that. So for our existing Mortgage Automator customers, we do have a US fraud kit and a Canadian fraud kit available to help you strengthen your due diligence process. They are practical resources built right into your everyday workflows. If you're not sure if you have access or how to use them, just reach out to your customer success contact and they'll get you sorted. For anyone who joined today who isn't yet a Mortgage Automator customer, hopefully this session raised some questions for you about how your current process holds up and how any of these integrations that our panelists represent could maybe plug into your workflow. Please reach out to us as well. We'd love to have that conversation with you. So you can email me directly at alex.smith@mortgageautomator.com. Kelly will drop that in the chat there so you can copy and paste it. I'll be happy to get you connected to your account executive. And we're also going to share some additional resources. So there's some links in the chat. We'll send those out in the email as well. I want to just thank so much Denise, Victor, Megan, and Chris. This was exactly the kind of conversation we were hoping to have today. So I appreciate you all sharing these great examples and your practical advice. Thank you for taking the time to be here with us. And thank you to our audience for joining. As I mentioned, we'll send out the recording link and those supplemental materials. You should have those tomorrow. And yeah, just thanks to everyone who joined. Thank you all so much to the panelists for participating. And we wish you a wonderful rest of your day.
Thank you so much.
Alex.
Thank you. Thanks,
you,
Mortgage
everybody.
Automator. Thanks, Alex.
All right. Thanks, Mortgage
Bye.
Automator.
Yes, thank you.